Welcome back. Bruce Porter joins us now for this week's Dollars and Cents segment. Good to see you. The allergy is still treating you a little.
It's disastrous.
It's this time of year is just great fun, isn't it?
Yeah.
I know.
You'd think by now I'd have it figured out, though, after 50 plus years.
You'd think we'd have it figured out, but no, not at all. Anyway, we're glad you're feeling a little bit better and you're back here. So we're going to discuss something today, the value of low volatility investment discipline, emphasis on discipline. What does low volatility mean? Exactly what it sounds like?
Well, I mean, what's the most important thing that a successful investor does?
Makes money.
Makes money. But I would probably say they manage their downside risk. Because we don't know what the volatility in the market is going to do to our portfolio. I think also successful investors look for consistency rather than the home run. Anybody can, a blind hog can find an acorn every now and then.
Every now and again, right. Yeah, well, but you need to be very careful with that because you roll the dice a little too much.
Well, we're only talking about your life savings.
Yeah.
And that one thing we discussed last week that's hard to replace when you're 70 years old. We insure everything, but we talked about insuring money. Well, managing downside risk, creating consistency in your portfolio, that can have some big benefits. So managing volatility, fluctuations can be very devastating to a portfolio, especially if you're in retirement and you're either depending on or planning on using that money for income. So, the markets are up, you're drawing some income. The markets are down, what do people do? They pull back. So they stop drawing income. So that affects your standard of living.
Sure.
So, my dad's retirement rules, they were pretty simple. He always told me, he said, son, here's what I want you to do. I want you to protect my balance. I want to draw a little income out when I need it. And I want you to grow my account as much as you can. That's pretty simple. So those three things, if you apply that, it sounds easier than it is sometimes, but those are pretty basic principles, Now, if we look at an example, take a $100,000 example, we're going to look at two portfolios, a stock portfolio and a balanced portfolio. Well, a stock portfolio, we're always looking to hit the home run. We're always looking for that big upside potential. So in this example, we're showing a 60% gain. So now you come home, you tell your husband, your wife, and they go 60%, you're a hero.
I'm a genius. Look at what I've done with our money. So 100% stocks in this one.
Right. And so now you're up to $160,000.
Fabulous.
So in the balanced portfolio, you only had a 30% gain, but I think you'd agree with me, that's still a pretty good gain.
I'd be super proud of 30%, yeah.
But in this example, half what the stock did, all right? So now that's in year one. Year two, the stock loses 40%. So now you're sleeping in the doghouse, right?
Yeah.
Or on the balance side, minus 10%. That example, both of those accounts average the exact same rate of return over a 2-year period.
But look at the end result.
But yet one is 96 and the other one's 117. So now what you do is you look at, you've got that upside potential, but because of volatility, you have that huge downside loss. And on the balance side, less upside, but less downside too. So managing volatility creates more accumulated value.
Are you an advocate of going into it with this sort of methodology younger, or are you a method of backing off as you get older?
Obviously, as you're younger, you can afford to have a little bit more volatility because you have time on your side.
Right.
But if you're retired at whatever age that is, I'm unemployed, now I want my money to work for me.
Right.
I would rather it not cross the street without looking.
Yeah.
Wouldn't you? So now, use this example again. Over a 15-year period, average rate of return, 5.66 on both of those accounts. One accumulated to $185,000, the stock account. The balanced account accumulated at $235 because the stock had higher upsides, but it had lower downsides. So in the years where the market suffered, the volatility really shot it in the foot.
Yeah.
If you apply a simple income of 5% per year, $5,000 a year on 100, at the end of 15 years, that stock account has $36,000 in it. The balanced portfolio's got 117. That's the devastating effect that volatility can have when you're retired and you're drawing just a small amount of money out for income. There's the effect it can have.